Real life.
Good morning, everyone. On behalf of TD Bank and our partners in this year's event, the Town of Orangeville, I'd like to welcome you to this year's Economic Outlook Summit. I would like to begin by acknowledging that the land on which we gather is the traditional territory of the Anishinaabe people, including the Ojibwe, the Potawatomi, and the Ottawa of the Three Fires Confederacy. My name is Mike Ruby, and I'm the Area Manager of Small Business Banking with TD Canada Trust, which includes the Orangeville and the surrounding area. TD has been a proud sponsor of the town's annual Economic Outlook Summit and business development activities of the Orangeville and Area Small Business Enterprise Center. We've developed a strong working partnership for many years with the SBEC and have been proud to support the excellent work of the Economic Development and Cultural Office. Despite the challenges brought by the pandemic, the Economic Development and Cultural Office was able to pivot to offer their services online for the past 3 years, continuing to provide seamless service to our region's business community. The office provides business counseling and advice, business registration, assistance, mentorship, referrals, entrepreneurship training, and many more services for people wanting to start a business. At this time, I also did want to share some recent news that TD Bank Small Business Banking has been named the highest in small business banking customer satisfaction among the big 5 Canadian banks. In these uncertain times, we know that small business customers need much more than just a bank account. They need financial guidance and trusted advice from someone who is committed to helping them and their business thrive. We couldn't be happier that our customers are feeling that they get that support from TD. On behalf of Charlene Glover and Cindy Fuller, our local account managers, thank you to our customers for their continued support and business. Now, this is our third and hopefully final year that we bring the annual Economic Outlook Summit to you virtually. We look forward to returning to an in-person event next year. This morning, you'll hear about the latest economic trends influencing the globe, our country, our province, and our local community. We are really happy to welcome Leslie Preston, Managing Director and Senior Economist at TD, later this morning. This event is being broadcast to you live on YouTube and will be recorded. We are inviting audience participation through the monitor chat box, which you can access at the top right-hand corner. To post to the chat, you must be logged into YouTube. Please use the chat box to post your comments or questions for our presenter, and you are welcome to do this throughout the presentation. Following Leslie's address, there will be time for Q&A period. Now, it is my pleasure to welcome Orangeville Mayor Sandy Brown to bring greetings on behalf of the Town of Orangeville. Sandy.
Thank you very much, Mike. On behalf of the Town of Orangeville, I'd like to welcome everyone to our annual Orangeville Economic Outlook Summit. We're pleased to be offering the summit virtually again this year and to be co-hosting this morning's event with our partner, TD Bank. TD is a strong supporter of our community and its businesses, and we are pleased to have such a productive relationship with the bank. Thank you to TD for supporting our business development efforts. The Town of Orangeville is also supported by its Business and Economic Development Advisory Committee, and I'd like to recognize our volunteers for the 2019 to 2022 term, including our BDAC Chair, Councillor Joe Andrews, along with members Buddy Pitt, Wendy Edwards, Paul Servini, Linda Horn, Troy Brett, and Diana Morris. Thank you to all. More than 2,500 businesses are operating in Orangeville, and these operations employ more than 12,000 people. These businesses create jobs, they create diverse revenue streams, and they support other businesses by buying local. The past 2 years have brought unprecedented challenges and upheaval for municipalities across Canada, yet despite the hurdles presented by the global pandemic, our local businesses continue to demonstrate incredible resiliency. Between 2020 and 2021, business investment in construction increased markedly, the regional unemployment rate improved, and the total number of businesses and jobs in Orangeville rose slightly as well. The town continues to recover from the pandemic by offering seamless program delivery to the business community and pursuing funding opportunities with our federal and provincial partners to support business recovery and growth. A new community improvement plan has been adopted by council, and when implemented in the coming year will enable the town to offer financial incentive programs geared to supporting the revitalization and enhancement of the community. A $66 million partnership with Whiteman to install more than 350,000 meters of fiber optic lines in Orangeville is well underway and will serve as a critical business attraction and retention tool, as well as providing improved service for those who are taking part in work from home or study from home. I'm very pleased to welcome you today, and like you, I look forward to hearing the economic forecast for the upcoming year. I hope all of you enjoy this morning's program. Over to you, Mike.
Great. Thanks, Sandy. Appreciate that very much. And also, I have to be remiss to say thanks very much for all of your leadership and support over the years, leading the town of Orangeville and in the community. So congratulations.
Thank you, sir.
Right now, I'm really pleased to introduce our keynote speaker, Leslie Preston, Managing Director and Senior Economist at TD. Leslie has over 15 years of experience as an economist and has been with TD Economics since 2011. In her current role as Managing Director and Senior Economist, she leads a team of economists to provide policy analysts and forecasts to TD clients and stakeholders. The team delivers on a wide scope of research covering the US, Canadian, and global economies. She regularly speaks about the economic outlook to various internal and external audiences and provides economic commentary to the media. Leslie holds a Master of Arts degree in economics from the University of Toronto and a bachelor's degree in economics from Queen's University. Welcome, Leslie. Great to see you again.
Thanks very much. All right, without further ado, I'll share my presentation for this morning. I'm going to speak for the next about 45 minutes, maybe not quite that long, on where TD Economics sees the global economy headed over the next couple of years. And as Mike mentioned, there will be time afterwards to ask your questions. So I hope that my presentation sparks some curiosity and some questions on your part. So before I look forward into the outlook, I'm going to look back a little bit. We're, of course, coming out of a global pandemic, during which there was huge fiscal and monetary supports here in North America. Central banks dropped rates basically to zero. Government stepped in with assistance for individuals and businesses. And with every new variant that came through over the past couple of years, policymakers were worried we would be thrust backwards economically. But I think the pleasant surprise in all of this is that we haven't been. As Mayor Brown mentioned, businesses have been very resilient, adapted to the new reality of COVID. And I think that a lot of the challenges you're going to hear me talk about stem from the fact that the economy, particularly here in North America, has actually rebounded very strongly from the COVID-19 pandemic. In fact, government supports were so strong, if you were to look at personal income growth through the pandemic, given all of the fiscal supports, it wouldn't even look like a recession. COVID-19 did generate a recession in North America, but when you look at income growth, basically there was no recession. So perhaps in hindsight, it's not so surprising that the economy has rebounded so much, because once the restrictions and caution have been lifted, businesses and consumers have come back with a vengeance. So the challenge has been, and you're going to hear me talk about inflation a lot, which I'm sure is on a lot of your minds, is that when this pent-up demand and strong income growth sort of ran up against limitations on the supply side of the economy, how quickly businesses and industries that were effectively shuttered could reopen and meet this surge in demand. This is really what has produced the incredible inflation that we're seeing right now. So without further ado, we economists love slides, love charts, and this is a rather busy one. But what my point with this one is looking at inflation across key advanced economies. The dark green bar is headline, the lighter green is core, and just showing that it is high everywhere. The red dotted line is roughly where most economies or central banks want inflation to be. That's the 2% target. In Canada, the Bank of Canada looks at a range of 1% to 3%. So you see that really everywhere inflation is well above target. And so this isn't a challenge that the Bank of Canada or Canada can fight on its own. It really is a global battle, and central banks around the world have started to fight inflation very aggressively in 2022 by raising interest rates. And just for a break from a chart, inflation is keeping central bankers up at night. Red hot inflation is not just worrisome for you and I when we go to the grocery store or when we fill up our tanks. It also is very worrisome for central bankers like the Bank of Canada, because once the inflation dragon has escaped or has been unleashed, it's very challenging to tame it. And what central bankers don't want to happen is for business and consumer expectations for inflation to be higher. The Bank of Canada has spent 30 years anchoring inflation expectations at between 1% and 3%. And they've been very successful in doing so. But the longer inflation runs hot, the more it will be incorporated into expectations. And the reason economists are always talking about expectations and why it matters for monetary policy is that is when you start risking getting into a 1970s, early 80s style wage price spiral. Businesses and workers expect inflation to remain high. You get collective bargaining and wage adjustments higher, which then further fuels high inflation. And that is what gets difficult to contain. So in the post-pandemic economy, due to the factors I raised about, pretty strong income growth running up against constraints related to the pandemic on the supply side, this inflation dragon has been unleashed, and we've got poor little central bankers being dragged behind in the dust, raising interest rates, trying to contain it. So as central bankers have been raising rates aggressively, longer-term bond yields have also risen. Again, just to set the backdrop that it's not just in Canada. These are 10-year government bond yields for Canada, the US, the UK, Germany, and Italy, Canada being the green line. So you can see through this year, it has been quite a remarkable rise in longer-term bond yields. In Canada, just for example, the 10 years risen from 1.74% a year ago to about 3.6% the last time I checked. That's a huge swing in yields, and it's been quite disruptive for financial markets which have had to adjust to a higher rate environment very quickly. Now, that said, just to get a little ahead of myself on the forecast angle of things, we do think that longer term bond yields are getting close to their peak. We think that by the end of next year, central banks will be needing to cut rates again. And as markets work in those expectations early next year, we do think we are reaching a peak in these longer term interest rates. But as I say, financial markets have been digesting, some of the highest interest rates and bond yields they've seen in years. And this has driven financial stress. On the left-hand side of your graph there, that's a TD Financial Stress Index for the US, and we've circled the current period yellow. It's a concerning period, but we're nowhere near the level of financial stress that we were in either at the peak of the COVID pandemic or back in the financial crisis. And even we're getting a bit more akin to the European sovereign debt crisis. You may recall from just over 10 years ago when European countries were struggling to pay off their post-financial crisis debts, and the European Central Bank intervened quite strongly. So the other thing, of course, driving these strong flight to safety flows is Russia's war in Ukraine, which has put Europe into an energy crisis. I'm not showing European financial stress, but if you were to look at a measure of European financial stress, you would find that Europe is headed towards recession. Most of the big economies in Europe, we do think, are headed to recession as a result of the energy crisis driven by Russia's war in Ukraine. These flight to safety flows in markets have also driven huge flows into the US dollar. This chart on the right is the trade-weighted US dollar year-on-year change, a very volatile line there, but just focusing on the more recent period, the US dollar is up about 16% just from the summer alone. And this has a lot of consequences for the global economy. It's particularly challenging for emerging market economies, many of whom have debt that's denominated in US dollars, so it makes it more difficult for these economies to repay their debt, often slowing growth. So the financial stress is a key negative in our outlook, and softer demand from emerging markets in particular are expected as a result of this. Now, in terms of the moves in the US dollar and what it means for Canada, the Canadian dollar is down against this backdrop of US dollar strength. But if you look at the Canadian dollar against other currencies, just a few here, the yen, the the pound, Norway, the euro, the Australian dollar, Canada's actually fared relatively well. It's down roughly 11% against the US dollar, but on a trade-weighted basis, it's down about 5%. And looking ahead, I'm preempting a couple of slides ahead, but with the Bank of Canada already starting to slow its pace of interest rate cuts, we got 50 basis points in October when we had expected 75. The Canadian dollar has weakened a bit, with the Fed looking a little more hawkish, like it's going to raise interest rates more than the Bank of Canada. We do think there could be a bit further weakness in store for the Canadian dollar. Our forecast for next year is around 71 cents US for the Canadian dollar, oscillating around there, as we expect this continued strength in the US dollar to not go away anytime soon. So, I've talked a little bit about inflation and how it's high everywhere, and it's really stayed high longer than either ourselves or central banks expected. So we've been quite wrong, admittedly, on inflation. However, with that said, not to be the economist who cried wolf, but we are seeing some positive signs that globally some of the inflation pressures that have driven the current 40-year high in inflation are starting to ease. And I'll just take you through a couple of those signs. So one of the first positive signs is global freight rates. So this is how much it costs to ship a large container by ship. We saw really that those costs ran up significantly in 2021 as particularly demand in the US really surged as the economy reopened, and also US consumers had a lot of money in their pockets to spend on goods. So we had a huge surge in freight rates, and those are now coming down. I'm sure we've all experienced supply chain issues, either in our businesses or in our personal lives, having to wait a lot longer for that piece of furniture or electronic or key component to arrive. We have been seeing, however, that some measures of these supply chain issues are starting to fade, both the backlogs of work and the supplier delivery times. The negative going down means that the supplier delivery times are worsening, and going up means they're improving. So again, in recent months, we have seen some improvement on this score. Also, as far as commodity prices are concerned, this is a commodity price index by various types of commodities, which of course led by energy when Russia invaded Ukraine, of course, peaked earlier this year. Now, commodity prices are still high, but they are coming down. And inflation, of course, is measured as a rate of change. So you don't actually need prices to fall for inflation to decelerate. You just need them to stop going up. And so we're certainly getting some help on the goods side. All of these factors I'm listing will help with goods inflation. And finally, the last key factor that we see as helping inflation in the coming months is the slowdown in China. China's economy is dealing with both a slowdown in its real estate property development sector, in addition to it still really sticking to its zero COVID policy. You may have heard in the news, when you get outbreaks of COVID in parts of China, the government's taking quite a hard line with shutting down factories, shutting down areas of the economy to try to contain the spread of COVID. And both that and the correction in the property sector are taking a toll on Chinese growth. Now, China is a huge economy, of course, in the scope of the world. And when China slows, that's less demand for things like commodities. That's part of the reason we've seen commodity prices come down. But just demand for many raw materials and items in general will have knock-on effects to slower growth globally, and also to weaken inflation pressures. This chart just shows a couple of different metrics that we would watch for Chinese demand, rail traffic, and also on the right, the bars is construction put in place and that's what I mean by the correction in the property market there. So we are seeing China certainly slow. Now, just switching gears back here to North America and where we see things going in the US economy. Of course, we're facing the midterm elections today. And perhaps, I'll just take a moment here just to talk a little bit about the midterm elections, because I do find that's frequently a question at the end. The pundits would say that it looks like Congress is going to swing to the Republicans. And often I get asked what that means for the economic outlook. And my answer is typically, it actually matters a lot less than you might think. Congress, the Democrats have had a majority in Congress, but a very narrow majority in the Senate. So they have managed to pass some major pieces of legislation, but, they haven't been able to implement their full agenda due to their thin majority in the Senate. So I think, we'll have further gridlock ahead with a divided Congress, but I think, even if the Congress had stayed Democratic, we were likely going to be in that situation anyway. I think the US politicians and government recognize that the time for big spending packages is past. So in terms of fiscal spending and how it impacts the economy, we weren't likely to see big measures coming in the next couple of years. If Republicans win Congress, we could see a lot of brinksmanship when it comes to renewing government spending and the debt ceiling. So there could be more volatility on financial markets, as Republicans are likely to want to see more fiscal restraint, spending cuts, which Democrats likely won't want. So all that to say, fiscal policy would likely to be less of an influence over the next couple of years. It's interesting. Republicans always care the most about fiscal restraint when they don't control the White House. You may recall during the Trump presidency, they passed massive tax cuts and spending increases, driving the deficit a lot higher, which you don't typically associate with more conservative parties, but they do tend to be very conservative when there's a Democratic president, as we saw in the previous Obama administration. A Republican Congress brought in quite restrictive spending cuts, which did drag on the economy. So that would be more of the risk there. However, that would actually be a plus in terms of the fight against inflation if we're seeing more of a fiscal contraction. So we can talk a little bit more on that in the Q&A, but that's just my little aside on the midterm elections, that I think in general, elections matter for the economy, matter more less on the margin than a lot of people think. So looking at the US economy, you may have heard in the headlines earlier this year, of course, talk of recession has increased in the US, and that was partly driven by, in the first half of this year, the US did actually see 2 quarters of contractions in GDP, which is often, a rule of thumb definition for a recession. But the difference in the US was typically an organization called the National Bureau of Economic Research is typically the group that gets together and decides whether the US has had a recession or not. And what was going on in the first half of the year, you really only had a contraction in economic growth, in GDP. Both the job market and income growth was very strong. So it wouldn't meet the definitions across a wider suite of indicators of a recession. And one way of thinking about it is that really the US economy was suffering from long COVID, that a lot of the effects of COVID in the economy in the first half of the year weighed on growth. In Q1, we had a big surge in imports, which weighed on growth. And a lot of that came as the resolution of the supply chain issues, a big surge in imports. And in the second quarter, the drawdown in inventories, businesses really ramped up inventories in the latter part of ramped up their expected inventories in the latter part of 2021 because of all the supply chain issues businesses have been facing. And if you don't get another ramp up in inventories the next quarter, you get a drag, which is really what we saw in Q2. So some temporary factors, really to simplify, that were weighing on GDP in the first half of the year. All that to say, we did see a return to modest growth in the third quarter, but we do expect that slower growth is ahead for the U.S. economy. The Federal Reserve, like the Bank of Canada, has raised rates very aggressively, so we do expect a period of slower growth. Now, of course, the big question everyone wants to know is, are we headed for a recession? We would argue that's actually the wrong way to think about it or to look at it, because central banks have by necessity raised interest rates very high to combat inflation, and that is going to produce a period of weaker demand, slower growth in the economy that's necessary to bring down inflation. And our forecast, you'll see later in a chart for Canada, we do expect the unemployment rate to rise in both Canada and the US as a result of this slower economic growth. And whether we see an official recession on the GDP front or not, I think it matters less. It's not going to feel great. It's going to be a couple of years of softer demand to bring inflation pressures back down to earth. But in terms of what financial markets are predicting about a recession, often financial markets look at the yield curve and whether it inverts as being a pretty good predictor of a recession. I need to update this chart. As you can see, the last observation was the end of September. But both measures, when you look at the difference between a longer term bond yield and a shorter term bond yield, so the longer term rate is lower than the short term, meaning markets expect rates to fall, which is typically ahead of a recession when growth is expected to slow. They are calling for a recession sometime in the next 2 years. The challenge with this as an indicator is 2 years is a long time, and a lot can happen in 2 years. And in fact, if you look at right before the gray shaded areas in the graph are previous recessions. And the yield curve was actually inverted in 2019. And at the time, everyone was worried about whether we were headed, particularly in the US, into a recession because the Fed had been raising rates and it had been a long time. It had been a long economic cycle without a recession. And we did, in fact, get a recession, but financial markets didn't get it right. I mean, they weren't predicting the COVID-19 pandemic. So a lot of things can intervene on whether there's a recession or not. But when you look at signals from the real economy in the US, this is a leading indicator we calculate from a basket of indicators, things like building permits, manufacturing output, hiring. When you look at this, momentum remains pretty good. You can see that it has slowed from the peak of the COVID sort of rebound, but this red line would historically be where we get to prior to a recession, or just as a recession is hitting. And as you can see, we're still reasonably far away from that on the US economy. The indicators were pretty good. In fact, you might have heard some headlines last Friday on the jobs numbers, both in Canada and the US, and labor markets are really drum tight in North America. This is a chart just comparing the unemployment rate for Canada and the US. Canada's current level is 5.2%. I've just traced that line back in the red line just to show that how far below it is. Even the economy, you may recall, quite hot in the late 90s. Unemployment is much lower than that in Canada now. And similar for the US. The US has reattained its pre-pandemic unemployment rate low of 3.5%. And, despite all the economic worries on financial markets and high inflation, we really have seen quite healthy job growth in both Canada and the US. So the central bank really faces a tough challenge. They look at the labor market for signs of a hot economy and inflation pressure. And, despite the fact that economic growth is slowing and they've raised interest rates by a historic amount in the past year, they look and they really do think they need to raise rates higher. So just where we think interest rates are going for both the Bank of Canada and the Federal Reserve, we don't think either central bank is done. Our current expectation for the Bank of Canada is that they get to 4.25%. I think since we did this forecast in mid-September, I think that's looking a little higher now, particularly with the strong job numbers. The Bank of Canada has raised the overnight rate so far to 3.75 or 3.75%. We think the risks are they could go a bit higher to 4.5 or so, just given strength in the labor market. When the Bank of Canada raised rates 50 basis points, they did cite slowing in the labor market as part of the reason. They also cited interest rate sensitivity in Canada, and I'll get into that in a moment. But the stronger job numbers really that we saw for October on Friday really changed the narrative on that a bit. You get a couple of months of weakness through the summer, and we all thought that was the Canadian economy slowing. And then you get another number that sort of undoes all of that, and you realize, that perhaps the previous two numbers were just a temporary aberration. So we do think that means that the bank may need to raise rates a little more than we had predicted in our previous forecast. And similarly for the Federal Reserve, we heard from the Fed last week, also expected to slow their pace of interest rate hikes, but Jerome Powell, the Federal Reserve chair, did point out that they think they're a long way from being done. We do think that the policy rate in the US will get higher than Canada. The US is facing a more persistent inflation problem than Canada seems to be. They had a lot more fiscal stimulus than we did in Canada, despite, we did have very generous programs like CERB for Canadians who, lost jobs or income due to COVID. But the US actually sent out several rounds of checks to everyone with incomes below a certain amount, whether you lost your job or not. So there is quite a cushion of, and I'll get into this in a minute, of excess savings that are expected to drive consumption in the US. So we do think the Federal Reserve will need to raise rates farther than the Bank of Canada, which is part of the reason why, as I mentioned earlier, our outlook for the Canadian dollar is a little softer. So the title of this slide is that there's a strong risk of a policy rate overshoot. And what we mean by that is that the challenge of being a central banker and running monetary policy is that the effects of your decisions take 18 months, 2 years to completely work their way through the economy. So they raise interest rates and they run their forecast models and they're trying to estimate how much they think they're going to slow the economy, but they never know they've gone too far until they actually get there. And this is why financial markets are expecting lower rates in the future. They think that ultimately, in the not too distant future, central banks are going to need to take some of these rate hikes back. So this is a risk, of course, that the tightening does drive the economies into recession. And notably, I think the heads of the central banks in Canada and the US have kind of stopped talking about that. They used to talk about trying to have a soft landing. And I think they've recognized a bit that the window is narrowing to actually get a soft landing. Inflation keeps surprising to the upside. They know they need to be aggressive with rate hikes, and that may mean a recession. And I think Governor Macklem at the Bank of Canada was asked about this, and he dodged the question a fair bit. He didn't want to use the word, but the Bank of Canada is forecasting a significant slowing in growth as a result of their interest rate hikes. So moving right along to Canada, you'll notice in our outlook for the Canadian economy that two of those pictures on the title slide are of houses. And of course, the housing market is always a key issue for the Canadian economy. We here in Canada are quite obsessed with housing. So that's where I'll start the Canadian outlook on the housing market. Just 1 second. I'm just going to have a quick sip. Pause my voice for a second. So where do we see the housing market going? Of course, the housing market is digesting massive interest rate increases from the Bank of Canada, and we have seen big moves in the housing market. But we want to emphasize this: we haven't really seen what I would call a confidence shock in housing. And this graph shows inventories on the left, the month supply of inventories in the resale market. So, we had very low inventory through the pandemic, as people call it, the race for space. And people decided, if I'm going to need to spend so much time in my house, I need more room. A lot of people decided to move during the pandemic to take advantage of ultra low interest rates on their mortgage. And we have seen the market become better supplied in recent months. That's that line going up. But if you compare it to the past 20 years, it's actually still a fairly tight housing market. We haven't seen, a real loss in demand. A little bit better balanced, but not a huge deterioration. Similarly, when we look at the construction pipeline and whether there would be a buildup of units coming on the market, say condos that haven't been absorbed, we're not seeing that either. So, we're calling what's happening in housing a recalibration, of course, with, mortgage rates up as much as they have gone in the past year or so. That does affect prices. It affects how much people can borrow. But overall, we're not seeing a huge demand or confidence shock. And we think there's actually pretty positive support for housing fundamentals in Canada. This graph shows Canada's population growth in context to other similar economies, the European Union, the UK, and the US. Canada has had much faster population growth, largely driven by immigration. We do have an aging economy and low birth rates like these other advanced economies. So this faster than average population growth really has been driven by immigration policy in Canada, which, when we think about an aging population and the fact, we all know about the shortage of workers in the healthcare sector. I mean, I would argue, Canada needs this, that Canada needs to have immigration to ensure that we have enough workers for our economy going forward. But the challenge is, we haven't really had the housing policy to keep pace with this. But all that to say, the federal government has relatively high targets for immigration. So looking at the forecast perspective, we continue to expect Canada's population growth to be quite strong, which would drive demand for housing. So all that to say, over the medium and longer term, we do think there's strong demand for housing, but we don't think the cyclical correction that we've been experiencing as a result of higher rates is done yet. We do expect a bit more cooling in the housing market. A lot of it has already occurred. But when the dust settles, we expect that Canadian home sales will have dropped by about 35% from the first quarter of 2022, which was the peak here in terms of sales, and a 22% decline in average home prices over the same period. I always think it's a little funny to talk about a national housing prices because nobody pays the national housing price, or there is no national housing market. It's always location, 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 and market conditions can vary a lot across Canada. But overall, that is the story for the national economy. This slide just focuses on the GTA, which it does not include Orangeville, but just for a general sense. The GTA is a little bit more vulnerable to higher interest rates due to the deterioration in affordability, a very high price market to begin with. We're expecting a 20% drop in average prices. If you've been listening carefully, you'll notice, well, wait a second, that's a smaller drop in prices than we're expecting nationally. And that has to do with, we forecast average prices, which in a way obscures the story, because the average price can be affected by the mix of housing that is sold in a particular month. If, for example, fewer high-priced single-family homes are sold and you get a move towards condos, the average price of what has been sold has fallen, but the individual prices of those housing units haven't necessarily fallen. You get this compositional shift, which is why we see less of an average price decline in the GTA, because with affordability being so stretched in that market, you get more people pushed into the condo market. So it's the mix of sales. We expect more condo sales relative to single family, which weighs on the average price. But all that to say that housing has been slowing everywhere, and this has an effect on the economy that really still has yet to be felt. This is measures of the economy that are related to housing as a share of overall GDP. And of course, you saw that during the pandemic, it really went off the charts with the overheated housing market. And we expect, so this is things like renovations, realtor commissions, activity in the resale market, new home construction. We expect all of that to slow relative to the economy as a whole as higher interest rates weigh on the sector. We think this is going to subtract about around a percentage point off of growth over the coming year. So it is a key factor in why we expect the Canadian economy to slow over the coming year. Another key factor that we expect to drive slower economic growth is really the challenges households are going to be facing as they have to tighten their belts. And they're getting this in a couple of ways. They're actually facing, three. There's a trifecta of headwinds against the housing market, the household sector. Inflation, I've shown inflation earlier in the presentation, but this just shows the history of how high inflation is in Canada on the left-hand side here relative to history. You need to go back 40 years to see inflation at this pace. So that's one challenge. It's inflation outpaces people's growth in wages. You need to make decisions as a household to consume less, choose cheaper alternatives, all those things that weighs on consumption. The other challenge is falling household wealth. And this is both from the declines in financial markets. People are seeing declines in their retirement portfolios, but also the falling house prices. And this wealth effect, as people see that, their net worth may have deteriorated in the recent quarter, that affects consumer confidence, and we typically do see slower consumer spending as a result of that. And as I'd mentioned before, higher interest rates. And just to underscore the impact of higher interest rates on Canadians, Canadians are going to have to spend a lot more servicing their debt over the coming years. And this is another of the key factors why we think the Bank of Canada is not going to raise interest rates as much as the Fed. I'll talk about the graph on the right-hand side first. This is the household debt service ratio. So this is economy-wide. This isn't like an average of an individual measure, but this is how much of personal disposable income Canadians pay to service their debt. So it's largely mortgage debt in Canada, but also includes consumer, car loans, student loans, anything like that. And you see, given the interest rate run up that we're experiencing, that ratio is going to get to an all-time high. Canadians are going to have gone from spending prior to the pandemic around 14% of their disposable income servicing debt to 16%. So that's going to be a key restraint on many household budgets. Of course, not all Canadians have a mortgage, but the share that do, we have a large share of people who are highly indebted, and this will be a major weight on their consumption going forward. And just to contrast that with the United States, who after their housing market crash really haven't seen the same degree of run up in debt in recent years. So their debt service ratio is rising too, but it's orders of magnitude different from Canada due to our high level of indebtedness. Now, fortunately, consumers do have a cushion of excess savings that's built up in the pandemic. That's the graph on the left. This is a phenomenon in both Canada and the US. Obviously, I'm different axes here. They're not really the same. The axes are a little bit more than a factor of 10 different. The difference between Canada and the US is that the US has already started to run down this excess savings. And perhaps I'll just take a minute here to describe what I mean in case you're scratching your head. During the pandemic, when we all had to stay home and socially distance, most of us spent a lot less money. We weren't commuting to work. We weren't, eating out at restaurants. A lot of the things we normally spend money on were restricted. And for most people, and because of general fiscal supports, our incomes weren't changed. So on both sides of the border, bank deposits rose quite dramatically. We can see that in the data. And so consumers have had quite a big cushion to absorb higher inflation. In fact, some analysis we've done on the US shows that if it weren't for this large cushion of excess savings, the US economy would probably have fallen into recession in the first half of this year. But because of this cushion, we expect that Canadians do have some ability to absorb higher inflation and higher interest rates, but it's still going to be a drag. So we do expect, this is a positive force in the economy, but those interest rate increases are still going to bite. So as a result of these three headwinds I mentioned, high inflation, higher interest rates, and the hit to wealth, we are seeing a slowing in consumer spending. This is data from TD on total debit and credit card spending. In nominal terms, it looks a bit more steady. This is how much it's up since August 2019. But when you deflate it by inflation in real terms, Canadians are starting to slow their spending. Still positive relative to 2019, but definitely signs of slower momentum. And we think that the Bank of Canada had similar data to this when it opted to start slowing its pace of interest rate hikes in October, that they did think that they are seeing signs that their interest rate hikes are having an effect on the economy, and consumer spending is slowing. Perhaps when we think about how interest rates act on consumer spending, it's typically those interest sensitive goods like housing, but also big ticket items like cars. And when we look at Canadian vehicle sales, it's currently at very low levels on a trend basis, similar to 2008, a long way from where they were prior to the pandemic. Now, part of this is as a result of, I'm sure you've heard about, supply chain issues and semiconductor shortages in the auto sector have been a restraint. People have had to, if you want to buy a new car, often there's long waits to get them. Those issues have started to resolve, and we haven't seen vehicle sales rebound in Canada the same way we're seeing in the US. The US, this measure has started to turn up. So we do think this is emblematic of the higher rates weighing on demand for these interest sensitive goods in Canada. So that's on the consumer side. Higher rates are also having an impact on business confidence. This is the CFIB's Small Business Optimism Index. The outlook over the next year and the outlook over the next 3 months. And we have seen some weakening in confidence since the spring. And this is, some of the reasons businesses cite are labor shortages, and this is where this tight labor market becomes a negative for the economy. Employers can't hire, and also rising input costs. Of course, businesses are affected by inflation too. So we have a consumer weakening and business weakening. So this is the key factors behind why we expect Canada's economy, which was growing very rapidly coming out of the pandemic, a very strong rebound. I'm showing Canada's green and light green, and Ontario's growth rate is dark green. We expect that to slow quite dramatically over the coming quarters. And this is a necessary, got ahead of myself there, a necessary slowdown to rein in those inflation pressures. Typically economists think of a concept of trend growth or potential growth, and that basically is like what we think the economy can run at based on growth in the labor supply and productivity. Those are really the two key ways that economies grow. They either have people working more hours or more people working hours and being more productive. And for Canada, we think that rate is around 1.8%, just below 2%. So when you had growth well above that rate, that's when demand pressures build up and inflation builds up. So we really need to see growth for a prolonged period of time below that 1.8% to see inflation pressures ease. So, when you look at these growth rates we're forecasting here and the question of recession, this is where I say it's a bit of a semantic question because, slow growth isn't going to feel great. We're expecting a higher unemployment rate. And there's a thin margin for error here. When you have growth running at 1% or less, you get, a 1/4 shock of some kind, and it would tip the economy into recession. But to the semantics point, we do expect the unemployment to rise, the unemployment rate. This is Ontario's unemployment rate. We do expect it to rise to around 6.5%, which is not a incredibly high rate historically, but it will act to slow demand. And in Ontario here, we are, as I mentioned earlier, and actually I used to have a slide on this. I think I'm going to have to add it back, but we are relatively sensitive to the downturn in our housing market. Ontario and BC really are the most sensitive provinces, the most run up in house prices, difficult affordability. So we do think that the slowdown in the housing market will have a larger drag on the Ontario economy. And perhaps I should have pointed that out in that previous slide, that you'll notice for most of these bars, we are expecting Ontario to grow at a slower pace than the country as a whole. And in part, that is due to the impact we expect a slower housing market to have. In fact, that's really already been underway in Ontario so far this year. This is our growth by industry. And when we look at 2022 GDP by industry, we are seeing quite a downturn in construction, and we expect that to go on next year, albeit at a slower pace. But growth slowing across the board. Services, other good sectors like manufacturing are expected to slow as well, driving these slower growth rates. So just to sum up a few of my messages here, you may have noticed, I haven't made a strong call, recession or not, and that's the point is we can't say for certain if we're tipping into a recession or not, but we do expect 2 years of pretty soft growth, which are necessary to bring the inflation into control. And whether we get an actual recession or a period of slower growth, it's not going to feel great. We do expect the unemployment rate to rise. So whether it's a recession or not is really a bit of a semantic debate. Also, just for context setting, we have just come through a global pandemic, which was the largest economic shock most of us have seen I would argue all of us have seen in our lifetimes, and the economy emerged more resilient from that. So I think when we look ahead to a potential economic slowdown, I think we know that the natural state of the economy is to grow. Recessions are temporary, slowdowns are temporary, and just to remember that when thinking about the next couple of years. So I guess not to panic. We've been through some pretty big challenges. Before the pandemic, we had the global financial crisis, and we emerged from that as well. So, all that to say, trying not to be too pessimistic here, just providing a bit of context to, how the economy has fared. But before I open it up for questions, I'll just do a little self-promotion here. That website address is for our department's research. If anything I've talked about here, if you want to delve a little deeper into it or read our weekly commentaries on the economic data, I would encourage you to check out our website. And also, we tweet all our research out. I know people have different feelings about Twitter these days, but that is one way to keep abreast of our research is to follow us on Twitter. So at that point, though, I will stop sharing my screen here and open it up. I believe we're going to open it up for questions.
That's great, Leslie. Thanks very much. That was a ton of information and some really great insights. So thanks very much for that. We did have a couple questions in our chat. And maybe, I don't know if I might have missed it or not, but just the impact of immigration whether or not that will have an impact on our employment over the coming months, and where do you see that factoring into the outlook?
Yeah, well, yes, of course. I mean, immigration, all the people aren't expected to show up all at once. I mean, it would certainly help. We do expect the unemployment rate to rise in Canada. So that means, the labor force growing at a faster pace than job growth. But you can have both growing. The growth in the labor force would in large part be driven by immigration, but that demand as the economy deals with a higher interest rates would not be as fast as growth in the labor supply. But as I showed with that chart in Ontario, we are expecting the unemployment rate to rise over the next couple of years. I mean, it's at a 50-year low right now. It's not, but that it would still remain reasonably strong by historical standards.
And I guess one of the other things that, sometimes it's on people's minds is just the government debt financing. So the governments have really stepped up to the plate over the last 3 years and pumping a ton of money into the economy as needed. But that has certainly left a lot of, governments, Ontario, Canada included, with some unbalanced balance sheets, I guess, for lack of a better word, right? So how do you see that kind of imbalance or the debt financing that the governments have almost had to do? Really, how has that weighed on, kind of going forward in the next few months and years?
Yeah, and in fact, you may have heard, we just got an update on that last week, at least at the federal government level. We got the fall economic statement from them. And their fiscal plan, they did have some spending measures in there, but at the same time, the trend recently has been, because of the strong economic rebound since 2021 and 2020, government revenues have actually been coming in pretty great, so coming in better than expected. So the trend has actually been for deficits to improve faster than expected. The federal government did choose to spend some of that sort of windfall, but overall, I'm just, as I cheat on my other screen here and look exactly at what the feds are expecting in terms of their deficit. They do still have a declining deficit over the coming years, getting back to balance by 2027. That does feel a bit far away, but I think as a result of that, most governments in Canada, Ontario as well, are focused on, getting back to balance. A period of restraint after a period of, necessary generosity. I think, in retrospect, it's, it is very impressive how generous governments were. And it really helped the economy rebound rapidly from the pandemic. But government has been a key support to growth over the past couple of years. And I think that influence is going to wane over the coming years as governments focus more on getting to, depending on which government you're in, or staying in balance.
For sure. Yeah, great. Any other questions from our audience? Well, you've done such a great job, Leslie. You've ticked all the boxes there. Well, if
one thing I could just say on the debt, I could just extend it out to the US. Often we in Canada, we worry about debt, and I think it's more of a concern at the provincial level, particularly here in Ontario. Ontario has a large degree of debt, but Canada is actually pretty good relative to the United States. I think when I talked about the midterm elections and the potential for fiscal restraint ahead, it's the US government that has what we would call a structural deficit. Previous administrations cut taxes, raised spending, and with baby boomers retiring and the necessity to spend on Social Security and Medicare, the U.S. is on an arguably an unsustainable path, and at some point something's going to need to be done. But so far, their fiscal situation has improved, but they really have a larger structural issue than we do in Canada. Canadian governments in the 1990s really wrestled that deficit issue through a lot of tough years for government spending, and we're in a much better position as a result of that.
Great, thank you. Mayor Brown, you had a question.
Yeah, Leslie, I'm not sure. I didn't catch all of that last question, but this idea of the run up of government debt, both at the provincial and federal levels, how much can Canada take? And are we getting into difficult times with respect to our overall debt in this country?
Yeah, so economists typically look at debt relative to the size of the economy. So, we look at debt to GDP ratios, and when debt's growing faster than the economy, then you get a buildup. And we certainly saw that through the COVID-19 pandemic.
Mhm.
Those measures have been turning in the right direction in recent years, and government budget forecasts. I was actually just quickly looking, the benefit of a virtual presentation is I could maybe try to pop a chart up for you from, but I'm not finding one immediately, that both Canada and Ontario's sort of debt to GDP ratio is on track to decline. I mean, I think there's a lively debate, particularly at the federal level. Could they do it a little faster? I think the answer is probably yes. With a minority government situation, so it tends not to. But as I say, as long as that is moving in the right direction in the outlook, I don't think too many, bond markets are worried about Canada. The risk is, of course, that, financial markets are worried about Canada's ability to pay its debt. And then, we have higher borrowing costs as a result. Spending on debt crowds out other spending on priorities in the economy. But I think Canada, as I mentioned, due to the tough work done in the past, is in a relatively good position. Sorry, I'm still multitasking here, looking for a good chart. But yeah, no, I can't find one at the moment. But it is the expectation that debt to GDP is headed on a downward trajectory, which is what you want to see.
And as a follow-up, there's been a lot of political rhetoric, both in Canada and the United States, over inflation, that this has somehow been caused by government policy in Canada at federal level or government policy in the United States, with the right attacking the left. Is this not sort of a global scenario here that's happened, or is there in fact influence by the federal governments in Canada and the United States on, this spike in inflation?
So I would say it's both. Often economists talk about inflation as being driven by supply or driven by demand. And on the demand side, I would argue it's not current actions of the government, but actions back in 2020 and 2021 with the generosity, not just of governments, but central banks. Hindsight is always 2020. Central banks should have been raising rates by the middle of last year. They were being cautious. People were still worried about variants shutting down the economy. So central banks are a bit behind the curve on raising interest rates. The income supports provided, not less so in Canada, more in the United States, but the United States is such a large economy in the world, it's affected inflation. All of the stimulus was probably too much. I mean, you had economists like Larry Summers saying that at the time, but hindsight is 2020. So there arguably was a bit too much stimulus, but not now. Like, that stimulus is done. Consumers have excess savings now that they can continue to spend. So you can't really put that genie back in the bottle, and it did help drive a strong recovery, which was good. So that's on the demand side. You could argue in North America there was too much stimulus, but it's not now. Like, all of those pandemic era programs are done. So the government has pulled back, but it's very challenging in the fog of a global pandemic to get that balance exactly right. How generous should the programs have been? How long should interest rates have stayed at rock bottom levels? But there have also been challenges on the supply side. One of the biggest forces in why inflation is so high was Russia's invasion of Ukraine. Central bankers weren't expecting that. That's had a massive influence, not just on oil prices, but grain prices, and higher oil prices trickle through to many areas of the economy. So that's really been a big challenge that governments had no control over. And also the supply chain challenges, like the semiconductor shortages, and port bottlenecks, and all of those things that have driven up inflation for goods in the past 18 months is not something governments could really do a lot about. I think that's mainly just the fact that the economy was adjusting to a once in a lifetime shock. You had this huge disruption that we, hadn't really seen since, people compare it to demobilization at the end of the Second World War, really is the closest comparison in history. So all that to say that, yes, it has become a very hot political issue. But I think policymakers are now doing what needs to be done to rein in inflation. And to the extent that you want to, quote unquote, like blame them, it's the actions in the past that were taken, in 2020, 2021, and those policies have ended. So, but as a policymaker, you worry, like, which was the type of mistake you wanted to make more? Did you want to transfer a bit too much money in the case of the US, or too little and have more people, lose their jobs and their homes? So it was a tough balance to strike. I don't envy people who are making these decisions in the thick of the pandemic in 2020, but
Very good.
yeah.
Thank you.
Great. I think we have time for one more question. If there's anyone that wants to ask Leslie a question. Mayor Brown, yes.
Well, do you feel that certain, I guess, are corporations taking advantage of this run up now? Do you think that there's some price adjustments that are happening now, just that they're riding this wave? And is all of this inflation real, or is it, I don't know, generated by greed in some cases with some corporations? Now, of course, that none of them would be TD Bank customers, but
well, I think inflation is real. Whether it was generated by greed or not, at the end of the day, people are paying more. So the end result is real. There have been some comments from central bankers in the US, not so much in Canada. Inflation's been running quite high in the US, higher than Canada. In the US, looking at, based on increases in wages, increases in input costs, that sort of in non-financial corporate businesses as a whole, that it looks like margins have improved in aggregate. So I think there is a nugget of truth to you saying, using, the backdrop of high inflation to pass on higher price increases to customers. In fact, I saw a comic a number of months ago where it was a little kid having a lemonade stand, and it said, it was $2 per lemonade, and then it was crossed out and it said $5. And the child is saying to the person who wants to buy lemonade, well, the war in Ukraine is really driving inflation. So there may be part of that. It's difficult to prove, but I think overall, can really look at an economy that emerged very strongly out of a pandemic, strong demand, sort of running up against constraints on the supply side. Zero COVID, and China's really, one of the key manufacturers of so many goods that we consume. Demand was up and supply wasn't able to keep up with it. I mean, anyone who's traveled over the past 6 months probably saw long lines at airports. Everyone's eager to get out there and travel again. That's against a travel industry that had to basically shut down and now is trying to ramp up quickly. So that mismatch of supply and demand has really produced what we're seeing as the highest inflation in 40 years. That said, I should, as I think about it, emphasize in future presentations, in Canada, we are seeing signs of inflation weakening a bit. And I think that is, again, why the Bank of Canada is signaling that interest rate increases are going to be slower from here.
Very good. Thank you.
We just had one last question that came in. Leslie, I think we've got time for it. How will the U.S. midterm elections impact interest rates? If shift to Republican control, then Democratic control, then question mark. So do you see much of a reflection on interest rates depending on the midterm elections?
Yeah, I think in alluding to my earlier comments, I could be a two-handed economist here. Economists are often guilty of like on the one hand, on the other hand arguments. So on the one hand, I think if we get a Republican majority in Congress, I think we're going to see greater spending restraint. And at the margin, that should mean lower long-term bond yields, lower inflation pressures. The central bank won't need to raise rates as much. So that's a negative for interest rates. At the same time, if we get this brinksmanship we've seen in the past in Washington between Democrats and Republicans, where, you know, they threaten to not raise the debt ceiling and that gets financial markets concerned, or, you know, another government shutdown like we saw under President Trump, that can be negative for financial market, which would act to raise interest rates. So you've kind of got two forces there. It's difficult to predict which would dominate, but I guess I would say in the short term, they could contribute to financial stress, driving interest rates a bit higher. But I would say over the medium to longer term, the spending restraint would be a positive for seeing rates, longer term bond yields at least, come down a bit.
That's great. Leslie, thanks for a great presentation. I think this is our second or third one together this fall, and as always, very, very informative. And I know it's been challenging as things are moving quickly and changing quickly, and updating your information. So great job as always, and thanks very much for taking the time to present to us. It really was great. So on behalf of TD Bank, Leslie Preston, and the Town of Orangeville, I'd like to thank everyone for joining us this morning. Great to see everybody virtually even. And we wish everybody all the best, and to stay well and stay safe. Thanks, everyone. Take care.
Bye now.